Welcome everyone to today's live stream, and to our listeners in Asia and the Middle East, a very good afternoon and evening, and to those dialing in from Europe, very good morning to you. And so we've arrived at the last investment outlook session for 2024. As such, for today's session, we'll like to dive into our crypto market outlook for 2025 as we seek to chart the escalating demand for Bitcoin in the new year. Once again, we have Katalin Tischhauser, Sygnum's Head of Investment Research and author of the Outlook Report, here to share with us her views and insights. But before I proceed, always a gentle reminder that all content and opinions presented in this live stream do not constitute investment advice. So without further ado, let's get the party started, right? 2024 has been tremendous for crypto, with crypto prices soaring to new all-time highs, buoyed largely by a crypto-friendly outcome at the recent US elections, coupled with the industry's achievement of significant milestones, including the launch of spot Bitcoin and Ethereum ETFs at the start of the year. Then we saw Bitcoin's fourth halving in April, and most recently, Bitcoin achieving its symbolic $100,000 mark. According to our crypto market outlook for 2025, next year is looking to be another one to watch closely. With that context in place, let's start our discussion by looking at demand shocks. So this year we have institutional inflows into Bitcoin surging, driven by the launch of the Bitcoin ETFs, as mentioned earlier on, as well as growing investor interest, amid, of course, the constraints of a limited supply. This has caused repeated demand shocks and, of course, price increases. Katalin, in your crypto market outlook report, you discussed the concept of demand shocks and how these could potentially send Bitcoin's prices soaring. Can you share with us, the audience here, where you see these demand shocks coming from?
Multiple sources. We are only actually seeing, you mentioned we have seen quite strong institutional inflows already this year, but we are only seeing the beginnings of this. It is the very first traditional financial institutions that are starting to make percentage allocations to crypto. We are very early in this trend. And in the context of the crypto market, these Ethereum and especially the Bitcoin ETF inflows appear large. In the context of the aggregate assets under management at these traditional financial institutions, these inflows have been very small, and we're really just seeing the beginnings of this. And in addition to that, central bank Bitcoin reserves are now on the table. They have become a real possibility, not just in the US, obviously, where this is being vocally advanced. Other countries are also considering it, reportedly, quite a number of them. Brazil, Russia have already filed similar Bitcoin Reserve Acts or made statements that they intend to. So have some US states, Pennsylvania, Texas have done so, and apparently many other US states are preparing to follow suit. Some local governments, for example, Vancouver. So this is now a very real possibility, and obviously it would lead to very substantial demand in the context of this small asset class. And even Jerome Powell said recently that he sees Bitcoin basically similar to gold, sort of an alternative to gold. And that means that actually comparisons of gold's market capitalization versus Bitcoin become a reasonable benchmark to look at. Now, gold's market capitalization is $18 trillion, Bitcoin's is $2 trillion. So how much should Bitcoin's market capitalization be, especially under a central bank reserve scenario? Should it be a quarter of gold's? That would be a 2.5 times increase from the current price of Bitcoin. Or should it be a third? Should it be half? Should it be something else? So these kinds of comparisons become legitimate. And this could also spill over into corporate treasuries. If central banks treat Bitcoin as a reserve asset, then corporate treasuries are likely to also look at it in a similar way. For now, this is not really happening beyond MicroStrategy or extremely small microcaps, mostly. And obviously, the Microsoft board rejected the shareholder proposal. There are other shareholder proposals being advanced, for example, at Amazon. But basically, if the central banks move, then I think corporate treasuries could be an additional source of demand. So all in all, demand shocks are very likely in the coming year.
Indeed. So there actually brings us to a very nice, perhaps a concept of this thing called multiplier effect, right? So we've seen all these developments as we've spoken about on the periphery, Katalin, and therefore support factors which support the potential demand for an uptick, and hence in turn bringing about this thing called the multiplier effect, wherein institutional inflows into Bitcoin have, as evidently as we have seen, caused significant delta in price movements. Looking ahead to the next 12 months in that case, do you think this multiplier effect could intensify further?
Yes, indeed. It's demand shocks are shocks because the supply is so small. If that weren't the case, then it would, of course, easily absorb the demand we have seen without price impact. But actually, the supply of Bitcoin and most crypto assets is very constrained. Even the aggregate market capitalization of all Bitcoin ever issued is quite small, but the circulating supply is even smaller. There is quite a lot of Bitcoin. It is estimated around 15%, 15% of all Bitcoin issued that is actually irretrievably lost, because in the early days of the crypto market, when Bitcoin was trading at pennies, people didn't really guard it very carefully and didn't hold on to their keys, and a lot of this is now irretrievable and lost forever. So the supply is already maybe just 85% of the stated supply, so to say, of all Bitcoin ever issued, and the liquid supply is much smaller still. So many Bitcoin investors are very, very long-term holders. It's sort of a store of value asset for a lot of investors. They've been holding it through market cycles. So not a lot of it is actually available. The exchange balances, which is usually, it obviously goes up and down and fluctuates, but that's usually considered the readily available supply of Bitcoin. That's 10% of the total market capitalization. So as this fresh demand comes to the market, there is little supply to meet it, and this is what causes the multiplier effect and the much steeper, as you called it, delta, much steeper price appreciation than would be expected if there were more readily available supply. And indeed, this multiplier effect escalates with the size of the inflows. What we have seen with the recent sized inflows, that for roughly every $1 billion of inflows, the multiplier effect was about 20-30 times in terms of how much additional market capitalization it induced. But obviously, if the inflows escalate even further, then so would the multiplier effect.
Sure. So, Katalin, you made a very good, strong point just now. Shocks are shocks. And so on that note, let's perhaps close off this section with a key topic we've been talking about since perhaps the fourth quarter, right? The last 3 times at least. US politics and corresponding crypto regulations have been major topics, right, as we have known. It is thus, therefore, not very surprising that an impending shift in economic regime and expectations of a more favorable regulatory climate in the US have fueled the crypto rally we have come to see since November, right, post Donald Trump's election victory. How do you see this playing out next year? And with his inauguration scheduled to take place a month from now, for how long more can we expect the current political uplift to continue supporting the market?
Yeah, that's a good question. And what we can see for now clearly is that Donald Trump appears to be absolutely delivering on his campaign promises. We have had constant news flow on cabinet nominations, many of them pro-crypto. Howard Lutnick, Elon Musk, Ramaswamy, even the Treasury Secretary,
Yep.
quite significantly, the new SEC chair, obviously establishing a crypto advisory council, this new White House role that he had nominated David Sachs for to oversee crypto and AI policy, and also other sort of announcements or reported by others that the transition team is considering, such as giving a much more significant role to the CFTC, which would be good news in terms of whether crypto assets in the US would end up being considered securities in the traditional sense or not, or even that he wouldn't wait for legislation to take its course with the Bitcoin Reserve Act, but sign an executive order. The CEO of Strike even said he could do this on day one of his inauguration. So we can expect more news flow, and also at this moment, hopes are high for regulatory clarity. That's very positive for crypto. Also, that in a best case scenario, regulation will be highly appropriate for the asset class, that it would be tailored such that actually it would allow projects to create token structures that pass real economic value to token holders. So the hopes are there. The delivery seems to be fully on track, but it's not yet fact. So when these hopes are realized, I think, first of all, there is more upside, and because it removes further uncertainty. But secondly, some new money is definitely waiting for example, regulatory clarity to be actual regulatory clarity, not just strong expectations of it. So I think there is more of it to come. Obviously, there's always periods of correction, and the market has had a strong rally. So that wouldn't be, if we take a slightly longer time horizon, that wouldn't be concerning. But I think if Trump really delivers, as he so far seems to be doing, not all of that is in the price yet.
Okay, right. So on that note, we shift away from, say, political, the factors, if you will, and perhaps take a zoom out towards the macro landscape and focus more on the economics, right? So for next year, or rather for now, we are seeing strong U.S. economic growth. The numbers, the quarterly GDP numbers came out strong, rising earnings. You have sustained consumer spending as well, and that's been a key, a bit of a paradox, right? As the Fed tries to slow things down, but behavior continues to be very encouraging, as well as a tangible pickup, of course, in the crypto markets. Katalin, should we expect this positive trend to continue next year, right? We've seen a bit of overnight we've seen that change in price per se, but on a broad basis, should we continue to see this trend next year?
Well, I would say, first of all, especially after yesterday's rate cut and the market reaction, that the bond market is clearly nervous. The bond market has been nervous since the rate cut cycle started in September. Bonds sold off straight away. Actually, between then and prior to yesterday's rate cut, 10-year yields already increased by 80 basis points, and then another 10 basis points overnight after yesterday's rate cut. So the bond market clearly sees this as a concerning trend, and certainly Donald Trump's stated policies are likely to be inflationary. So that has been priced in gradually by the bond market over the last couple of months. Now, Jerome Powell basically said the same, increased inflationary expectations from 2.1 to 2.5%, and it's all in light of basically the expected economic policies of Trump, with tax cuts and tariffs, which are likely to exert further upward pressure on inflation. And actually, this move in bond yields, it is actually entirely negating the liquidity-inducing effects of rate cuts, because people don't borrow in the money market. Mortgage rates, business loan rates are rising in accordance with bond yields, not with the short-term money market rates. So I think this could, further rises in bond yields could stall the bull market in risk assets. Currently, 10-year yields are around 4.5%. I think 5% is widely seen as maybe the danger signal. So if yields continue rising still quite a bit from here, it could get to that point. But then, as you say, the equity markets have been doing really well. So since the rate cut cycle started, bond yields have been selling off strongly, but equities have been making all-time highs. And yesterday was a down day, but not a serious down day. It wasn't
Exactly.
actually, it wasn't really a bad day. And I think that all in all, the backdrop will be certainly good enough as a backdrop not to hinder the crypto market, and probably okay for the equity market to do reasonably well. A lot of Trump's policies, while also some of them are inflationary, but also a lot of them are pro-earnings growth. Deregulation, tax cuts, basically this bodes well for corporate earnings, and that can support the equity market even in the face of, for example, sort of slight increase in inflation and the bond markets not being entirely bullish. And one other factor is the liquidity conditions. And I actually like to look at this, the National Financial Conditions Index. It has correlated almost perfectly with the US equity market. And unlike, for example, M2 or other metrics, so I really like to look at this index. It's run by the Chicago Fed. And that shows basically whether liquidity conditions are tighter or looser than their historic average, and currently they are really loose. So that's supportive of risk assets as long as that doesn't change dramatically.
That's very good coverage, Katalin. I think it keeps us on our toes, and maybe just to round off this part as well. Therefore, notwithstanding the various issues you've discussed, are there any other blind spots we should be mindful of, right, in terms of, say, potential risks and challenges that we should bear in mind regarding crypto?
Yes, I mean, maybe I would continue on the macro front that even though we see the backdrop as sufficiently benign currently as a backdrop for the market, if we zoom out a bit more, the macro environment is really increasingly fragile. We are seeing normal economic relationships breaking down. For example, since the rate cut cycle in 2007, 2008, which failed to inspire a bull market as it usually has done in the past, basically since then rate cuts have lost their previous effectiveness as a monetary policy tool. So that's kind of one relationship that has been breaking down. And since then, it's been liquidity injections came from quantitative easing and other ways of direct liquidity injections, and they have been the dominant force, not actually rate cuts. And other normal economic relationships have also broken down. For example, since 2021, this is really paradoxical, but we have seen unemployment and GDP growth to correlate positively, which seems to not really even make sense. But to me, this signals that the engine of GDP growth is no longer organic economic activity, but rather growth is subsidized by government spending. And basically, higher unemployment sort of keeps inflation in check to some extent. And this picture necessarily leads to the escalating deficit and debt that we have seen. Over the last 10 years, US government debt doubled and GDP only increased by kind of 50-odd%. Deficit has multiplied. Now, of course, the establishment of the Department of Government Efficiency, it is a positive move, and it is obviously a positive signal to the markets, and they will achieve results for sure. They will cut headcount, they will eliminate bureaucracy. They also said they intend to cut funding to various international organizations, NGOs, and so on. So they will achieve some headline results and savings, but it's hard to see that the size of the savings would come anywhere near to what they're targeting. The majority of US government spending is mandatory. 2/3 is mandatory, Social Security, healthcare. The discretionary spending is mostly on defense. That's not likely to be cut. It's likely to increase. Actually, Donald Trump has talked about creating an iron dome and so on. So it's likely, and of course, there's the interest payments which have to be made. So there's not a lot of room actually for reducing the deficit and the spending. And the policies of tax cuts and such are actually more likely to result in an increasing government deficit under the Trump administration rather than a reduced one. So one risk, to sum it up, one risk is that inflation will turn out worse than the market's expectations. Okay. Or that the liquidity cycle will be much more muted and not as positive as it's currently priced in by the markets. So that's one. We also have to mention geopolitics. I don't really want to elaborate too much on that, but multiple flashpoints around the world, that's also out there. And specific to the crypto market is various concentration risks, actually. There's multiple instances of this in the market. There's, for example, Tether's very high concentration among dollar stablecoins, 75% of the capitalization of dollar stablecoins. That's obviously, these kinds of concentrations are always a risk, and there's always reasons, certainly surrounding Tether, and most of these situations, how things could potentially go wrong. Another worrying concentration to my mind is MicroStrategy's leveraged holdings of Bitcoin. These now amount to 2 to 2.5% of the total market capitalization of Bitcoin, and a much higher percent of the liquid capitalization of Bitcoin. So these concentration risks are definitely something to keep an eye on.
Lovely. Thanks so much, Katalin, for keeping us on our toes and reminding us, there are things to always be aware of, notwithstanding the sunny outlook for crypto. So if we were to zoom in, therefore, our discussion onto more bottom-up issues, right? So we move away from the politics, the macro, into a bit more of the coins, the tokens. So extending our perspectives beyond the top-tier tokens, the usual names, the household names, we currently see meme coins dominating the altcoin market, outperforming other crypto sectors. In fact, data appears to suggest that 7 of the top 10 highest performing crypto assets this year were meme coins. So what are your thoughts, Katalin, on this trend? And do you think we could see an alt season that extends beyond the meme coins next year?
Yeah, so, first of all, I would like to say that a lot of the regulatory changes benefit of the alt sector more than obviously Bitcoin. Bitcoin hasn't really been held back very much by regulatory difficulties, and the rest of the market has. So these changes necessitate an upward revaluation of the alt sector. Some of this has already happened. Actually, it's happened since Gary Gensler's resignation. There has been a relative outperformance of the alt sector over Bitcoin since then. And there's kind of more of that upward adjustment that can happen just simply if the positive and clear regulation is put in place. But beyond that, what we have seen is what you're saying, that meme coins have been by far the strongest performing sector in the market. And it's a sector lacking fundamental value, outperforming the rest of the market substantially. This necessarily carries the risk of basically a bubble building and that bubble eventually bursting. It's not really a healthy market dynamic. It also diverts funds from more productive use cases, to be honest. So I'm not very happy about seeing this trend. And why is this happening? I think some of it has its roots in social causes, the increasing wealth disparity and a disaffected majority that sort of appears to see gambling as the only path to financial security. I think that is definitely part of the answer. But another reason is the lack of regulatory clarity that has prevailed until now, I think, because basically projects have not really been able to create token structures, and projects that are highly productive, generate a lot of revenue, have a lot of traction, so their tokens should be valuable. But they have not really been able to create token structures where this value accrues to the token in a clear way or at all. So basically, even the tokens of very productive and very successful projects have been trading as de facto meme coins, right? Sort of disconnected from the actual value creation because of the lack of regulatory clarity and regulatory obstacles. So I think if this changes, that could open the way, first of all, to a lot of innovation and a lot of growth. But then that would be a broad-based, fundamentally driven alt season that I would personally love to see.
Sure. No, Katalin, I particularly like your point about the focus on the need for fundamental value, right? And on that note, maybe if we were to perhaps tilt our discussion towards, say, stablecoin and Ethereum for that matter, how significant are their use cases and how could they evolve in the coming year?
Yeah, so two use cases that definitely look like they could have a breakthrough next year in terms of mass adoption, or the beginnings of mass adoption, is stablecoins in payments and tokenization. And the reason why I highlight these two use cases, first of all, with regard to stablecoins, there's a number of drivers. Most jurisdictions are working on stablecoin regulatory regimes.
Right.
Central banks, BIS, are supportive of properly designed and regulated stablecoins, but they're definitely in favor. There's a number of large traditional institutions, banks, and fintech giants that have already either issued their own stablecoin or are planning to do so. PayPal, Societe Generale, State Street, Mitsubishi, and a number of others. And also the US, and Donald Trump has mentioned this, the US sees dollar stable coins, it appears, as a means for reasserting dollar dominance. And at the same time, of course, stable coins backed by fiat reserves, which is what stablecoin regulation usually endorses or allows. They also create demand for government bonds, which in the US, as government that escalates and foreign governments are reducing their US Treasury holdings, is also seen as a great benefit of stable coins. So I think there are a lot of drivers in place, and it could be that if, for example, in emerging markets, stable coins used for payments, that can happen very easily because the alternatives are often not very attractive. In developed markets, this is less the case. There isn't a compelling narrative or a compelling reason in the same way, but some of the payments providers are now actually using stable coins as the backend. So that could lead to a lot of use and mass use in payments, where neither the originator of the payment or the recipient of the payment is even aware that stable coins are actually the rail that the payment travels on. So, for example, Visa is working on it, and others as well. So we could see that. And the other one is tokenization. And that, again, is predicated on the huge build-out that we are now seeing among traditional financial institutions and also amongst decentralized projects, working in tandem with them to trade, settle, issue tokenized assets. Also a lot of support here as well from governments and regulators, regulatory frameworks, legal frameworks being put in place, sandbox environments being offered to projects to experiment and innovate. And we just hear frequent announcements from leading banks and financial institutions that they're working on tokenization platforms or launching these platforms: Goldman Sachs, JP Morgan, Visa, BIS, and so on and so forth. And at the same time, asset managers are starting to launch tokenized investment products. We have seen BlackRock, Franklin Templeton, Fidelity, Janus Henderson, and this news flow is also constantly humming away. And also, key opinion leaders have been pretty vocal about the opportunity here. Just to mention a couple, for example, Franklin Templeton CEO called it the greatest disruption coming to financial services. After BlackRock launched the Bitcoin ETFs, Larry Fink said that the next step is the tokenization of every financial asset. And I think Deutsche Bank said that this could help address the structural margin compression in the banking sector. So there's a lot of intent, a lot of investment, very powerful large institutions moving on this. And I think ultimately, as the platforms are there, the investment is there, a breakthrough in user growth is likely to follow.
Wonderful. That in itself, Katalin, is a very appropriate segue to our third segment of today's conversation. So let's take a look at your likes of your Ethereum and Solana, right? And we continue to see Bitcoin retaining its popularity as a core holding, given its reputation as the first cryptocurrency to be introduced to the public. Separately, though, we see Solana beginning to pull its weight a lot in the crypto space these days as a challenger blockchain, as Ethereum appears to be lagging behind. Please share with us your thoughts on Ethereum, right? Katalin, will it hold its ground or face more struggles in 2025?
Well, actually, Ethereum's relative performance has bottomed about a month ago.
Okay.
After sentiment being, as you say, very negative on Ethereum for about 2 years. And this basically coincided with the inflows into the Ethereum ETFs beginning in earnest. So actually since the 22nd of November, we have had an uninterrupted stretch of positive net flows into the Ethereum ETFs. I'm not even sure if the Bitcoin ETFs have ever had a whole month of uninterrupted positive net flows. Mm-hmm. So this has been quite significant, and simultaneously the relative performance turned around. Relative to Solana, this turnaround in the relative performance has been sustained since. Relative to Bitcoin, it has proven temporary, but I think Bitcoin has really very, very strong and very specific drivers, so we can kind of put that aside. But for now, the relative performance versus Solana seems to have bottomed and clearly driven by the positive and strong inflows into the Ethereum ETFs. Of course, these inflows meeting a very limited supply, and of course, impacting sentiment very positively. And I think this acceleration of ETF inflows into the Ethereum ETFs, I think it's probably mostly simply due to the fact that the ETF issuers pitches have started landing. It's just taken some time. Also, a lot of platforms have a rule that products must trade for 90 days before they can even consider it. Of course, these ETFs started trading end of July, so it was roughly end of October that they could start considering it. So I think the timing had a lot to do with that, and probably the US elections and the bull market, it helped, of course, but was a bit more coincidental than the primary trigger. It actually is interesting that the inflows turning around coincided with Gensler's resignation. So I think that probably also had some impact just in the way that it's likely to affect the whole alt sector, which Ethereum benefits from. So we have seen this, and it looks like this is new money. We haven't yet seen the reports of holders at the end of the quarter. We will see that, but it looks like it's new money. We didn't see rotation, for example, from Bitcoin ETFs to Ethereum ETFs. It's incremental new money that's been flowing into these assets. And basically, as these inflows started and turned around, then the narrative support also arrived. It was a little bit a case of narrative following the price movement, but suddenly we have seen again sort of people extolling the well-known advantages and strengths of Ethereum. Basically, it's leading market share as a smart contract platform. It's very strong network effects that are hard to compete against. It's high security, longevity, stability, the upgrade roadmap, which they're of course very slow and steady in implementing, but definitely moving forward. So these have always been true, but they were ignored for 2 years, and now they're being highlighted again. So I think if the inflows are sustained, then this narrative support will also continue. And there's another factor that can help the Ethereum ETF inflows possibly, which is that regulatory changes may also allow ETF issuers to add the staking feature to the ETFs, and that would definitely further help the inflows. So I think as long as this adoption continues by institutional investors, then we would expect the positive trends for Ethereum to be sustained for a while. If we extend the time horizon and we ask the question, can Solana actually seriously challenge Ethereum? I continue to think that will come down to primarily whether the traditional financial institutions, as they move into use cases like tokenization and stablecoins and so on, if they will actually favor Solana over Ethereum. For now, we don't know. There's no actual signs really. There have been some statements, but then it's too early to say, and it may not be the case because of Ethereum's obviously stability and security and longevity. So we will have to wait and see. I think that will be a key factor to watch in over the longer term.
Understood. Well, Katalin, we've already come 6 minutes past the bottom of the hour. So we've had a very comprehensive discussion already, and I'm wary of time of yourself as well as our listeners. So to end off with one last question for 2024, and going back to that point you made about staking. So one area which we've seen growth this year pertains to that of restaking. And looking ahead to next year, how do you see this innovation of restaking and its implications for security and scalability of blockchains? Do you think restaking will keep growing?
I think so. This is a very innovative model that allows protocols to use the security of the most blue chip time-tested blockchains, which is basically Bitcoin and Ethereum. And it, of course, also allows Bitcoin and Ethereum holders to earn additional yield. These restaking protocols, they're barely just launching. So basically, EigenLayer a little bit earlier this year, that's the primarily focused on Ethereum, and then more recently Babylon, which is primarily focused on Bitcoin. And as they launched, they have seen very, very strong TVL growth. This trend is still in the very early stages, these protocols just barely launching, but I think this is very promising, and it creates additional demand for the blockchains with the best security, which is Bitcoin and Ethereum.
Lovely. Great. So, Katalin, as we round off, perhaps any last quick comments before I close this session for 2024?
Just Merry Christmas and a Happy New Year.
Wonderful. Thanks so much, Katalin. And with that, we conclude our last Outlook session for 2024. Many thanks again to everyone for joining us today, and also to all those who have shared your precious time with us throughout the whole of 2024. Thank you. Special thanks as always to Katalin for sharing her thoughts and insights over the last 12 months. And for those who are dialed in today for a quick deep dive into this and other important topics driving the crypto markets for 2025, please download the Crypto Market Outlook 2025 by Katalin from our website. Go on to the Sygnum website, click on the Learn section, and go on to Research and Education. That's where you'll find our reports, our thought pieces, our ideas, right? And please also do join our community on LinkedIn to stay up to date on our launches, news, and research. Till we next meet in 2025, here's wishing our audience, as Katalin has mentioned, a blessed Christmas and a good close to 2024. Good day, good afternoon, and good evening. This is Sygnum signing off.